Americans right now owe over $13 trillion on roughly 87 million mortgages. Let that sink in. $13 trillion. That is more money than the entire economies of most countries on this planet. And here's the part that should make you sit up straight. A study from Clever Real Estate found that 82% of Americans who bought a home in 2023 or 2024 have at least one regret about their purchase. 82%. That means if you put 10 homeowners in a room, only about 2 of them would say, "Yeah, I did everything right." So why are so many people getting this wrong? Why are millions of people signing papers they don't fully understand, paying hundreds of thousands more than they need to, and ending up trapped in loans that squeeze them dry? Because nobody taught them how home loans actually work. Not in school, not at home, nowhere. And that changes today. This is your full course on home loans, from the very first concept to the last signature on closing day. I'm going to walk you through every single step, and I promise you, by the end of this video, you will understand mortgages better than most people who already have one. But here's the thing. There is a secret about interest that banks are counting on you not knowing, and we will get to that soon. So stay with me. All right, let us start with the basics. A mortgage is simply a loan you use to buy a house. You go to a bank or a lender and say, "I want to buy this house, but I don't have all the money right now." The bank says, "Fine, we will give you the money, but you have to pay us back over time, with interest." That is it. That is a mortgage at its most simple level. You borrow money, you pay it back. You pay extra for the privilege of borrowing. Now, the word mortgage actually comes from Old French. It literally means death pledge. Yeah, death pledge. Not exactly the most comforting name, right? But it does not mean the loan kills you. It means the deal dies when you either finish paying it off or when you fail to pay and the bank takes the house back. Either way, the pledge ends. And here is something important. The house itself is the collateral. That means if you stop making your payments, the bank can take your house through a process called foreclosure. According to the Federal Reserve Bank of New York, only about 0.83% of all mortgage debt is seriously behind by 90 days or more. That number is small, but it represents real families losing real homes. So understanding how this works is not just about money, it is about protecting your life. Let us break down the 2 most important words in any mortgage: principal and interest. The principal is the actual amount of money you borrowed. So if you find a house that costs $300,000 and you put down $30,000, you are borrowing $270,000. That is your principal. It is the real number, the honest number, the number before the bank adds its profit on top. Interest is what the bank charges you for lending you that money. Think of it like this. You know when you borrow your friend's car and you fill up the gas tank as a thank you? The gas is the interest. Except with a mortgage, the gas can end up costing you more than the car itself. A study of amortization schedules shows that if you borrow $200,000 for 30 years at 6% interest, you will pay back roughly $431,000 total. That is more than double what you borrowed. Did you catch that? You borrow $200,000 and you pay back $431,000. The bank makes $231,000 in interest alone, and that is why understanding interest is the single most important thing in this entire course. We are going to go much deeper into this, but first, let me explain how these payments actually get divided up each month. Here is a word that sounds fancy, but is actually very simple: amortization. It just means the schedule of how your loan gets paid off over time. Every month, you make one payment, but that payment gets split into 2 parts. One part goes to the interest, the other part goes to paying down your principal. Easy, right? Well, here is where it gets tricky. In the early years of your mortgage, most of your payment goes to interest, not to the principal. So imagine you are paying $1,500 a month. In year 1, about $1,000 of that might go straight to the bank as interest, and only $500 goes toward actually owning more of your home. It is like paying rent to the bank while slowly buying the house at the same time. Frustrating, I know. But here's the good news. Over time, this flips. By the time you are in year 20 or 25 of a 30-year mortgage, most of your payment is going to the principal. The interest portion shrinks. According to mortgage amortization data, by around year 20, the amounts going to principal and interest roughly equal out. After that, principal starts winning. This is why people say the first few years of a mortgage are the expensive years. And later, I will show you a powerful trick to beat this system. Now let us talk about the two main types of mortgage interest rates: fixed rate and adjustable rate. A fixed rate mortgage means your interest rate stays the same for the entire life of the loan. If you lock in at 6% today, you are paying 6% in year 1, year 15, and year 30. It never changes. Never. And that predictability is why conventional fixed-rate loans captured roughly 70% of the market in 2024. Most people want to know exactly what they are paying every month. An adjustable-rate mortgage, or ARM, is different. It starts with a lower interest rate for a set period, usually 5, 7, or 10 years. After that introductory period ends, the rate can go up or down based on the market. So you might start at 4.5% for the first 7 years, feeling great about your low payment. But then in year 8, boom, it jumps to 6.5% or even 7%, and suddenly your monthly payment shoots up by hundreds of dollars. Here is what lenders do not always make clear. ARMs have caps, which limit how much the rate can change each adjustment period and over the life of the loan. But even with those caps, the increase can be painful. ARMs can work well if you know you will sell the house or refinance before the adjustment kicks in. But if you plan to stay long-term, a fixed rate gives you peace of mind. And peace of mind, that is priceless. Let us talk about down payments. The down payment is the money you pay up front when you buy a house. It is your skin in the game, your proof to the lender that you are serious. Now, there is an old rule that says you need 20% down. So if the house costs $300,000, that would mean $60,000 out of your own pocket on day one. That is a lot of money. But here is what most people do not know. According to the Consumer Financial Protection Bureau, the typical first-time homebuyer puts down only about 6%. And there are loan programs that let you put down as little as 3% or even 0% if you qualify for a VA or USDA loan. So this myth that you need 20%, it stops thousands of people from even trying to buy a home when they might already qualify. But, and this is a big but, the less you put down, the more you pay over time. A smaller down payment means a bigger loan, which means more interest. And if you put down less than 20% on a conventional loan, you will have to pay something called PMI, private mortgage insurance. We will get into PMI very soon. For now, just remember this. Your down payment is the first major decision you make, and it affects everything that comes after. PMI, private mortgage insurance. This is one of those costs that absolutely bothers people because it protects the lender, not you. Here is how it works. If your down payment is less than 20%, the bank sees you as a higher risk. You have less money invested in the home, so statistically, you are more likely to walk away if things go bad. To protect themselves, they make you pay for insurance on their behalf. PMI typically costs between 0.5% to 1% of your loan amount per year. So on a $250,000 loan, that could be roughly $100 to $200 added to your monthly payment. It does not go toward your house. It does not build equity. It is just gone. And that stings, especially when you know the money is not protecting you at all. But here's the good news. PMI is not forever. Once you build up 20% equity in your home, meaning you now own at least 20% of the home's value, you can request to cancel PMI. Some loans do this automatically when you hit the 22% mark. So the strategy? Get to that 20% equity mark as fast as you can. One way is making extra payments on your principal. Another is if your home goes up in value. We are going to talk about equity building strategies later that can save you thousands. Not all home loans are the same. There are 4 main types, and knowing which one fits your situation can save you a lot of money. First, conventional loans. These are the most common. They are not backed by the government. They typically require higher credit scores and bigger down payments, but they often have the best interest rates for people with strong credit. Data from HMDA filings shows conventional loans made up about 70% of the market in 2024. Second, FHA loans. These are backed by the Federal Housing Administration and are designed for people with lower credit scores or smaller savings. You can get an FHA loan with as little as 3.5% down. The catch? You pay mortgage insurance for the entire life of the loan, not just until you hit 20% equity like conventional loans. Third, VA loans. These are for military veterans and active service members. VA loans are incredible because they require 0 down payment and no monthly mortgage insurance. According to Freddie Mac survey data, VA mortgage rates averaged about 65 basis points below conventional rates in 2024. And fourth, USDA loans. These are for people buying in rural areas. Like VA loans, USDA loans can offer 0 down financing. They are not as well known, but for those who qualify, they are a fantastic option. Here's the key. Most people just go with whatever the bank suggests, but the type of loan you choose can be the difference between paying an extra $50,000 or keeping that money in your family's pocket. Choose wisely. If there is one number that controls your entire mortgage experience, it is your credit score. Your credit score is basically a number between 300 and 850 that tells lenders how likely you are to pay back money you borrow. The higher the number, the less risky you look. And the less risky you look, the better deal you get. The Consumer Financial Protection Bureau states that consumers with higher credit scores generally receive lower interest rates than consumers with lower credit scores. Now, what does that actually mean in dollars? It means everything. Imagine 2 people buying the same house for $400,000 with a 30-year loan. Person A has a credit score of 760 and gets a rate of 6%. Person B has a score of 620 and gets a rate of 7.5%. Person B will pay roughly $120,000 more in interest over 30 years for the same house, just because of a number. So what builds your credit score? 5 things. Your payment history, which is the biggest factor, how much debt you currently carry, the length of your credit history, the types of credit you have, and how many new credit accounts you have opened recently. According to the CFPB, errors on your credit report can lower your score unfairly, so always check your credit reports before applying for a mortgage. Fix those errors first. It could save you tens of thousands. Before you even look at a single house, there is one step you absolutely must take. Get pre-approved. Not pre-qualified, pre-approved. There is a huge difference. Pre-qualification is basically a quick guess. You tell the lender your income, your debts, and they say, you can probably afford around this much. No documents checked, no verification. It means almost nothing. Pre-approval is real. The lender actually pulls your credit, verifies your income, checks your bank statements, and gives you a letter that says, "We have reviewed this person's finances and we are willing to lend them up to this amount." That letter is gold. It is like walking into a car dealership with a briefcase full of cash versus walking in and saying, "I think I have money somewhere." Which buyer do you think gets taken seriously? According to multiple industry experts, one of the biggest mistakes first-time buyers make is looking at houses without pre-approval. You fall in love with a home you cannot afford, or worse, a seller rejects your offer because you do not have proof of financing. Get pre-approved first, then go shopping. This one step puts you in control. And in the housing market, control is power. All right, here is another number that matters. your debt-to-income ratio, or DTI. This is how lenders figure out if you can actually afford the mortgage you are asking for. The math is simple. Take all your monthly debt payments, your car loan, student loans, credit cards, everything, and divide that by your gross monthly income. That is your DTI. So let us say you earn $5,000 a month before taxes. Your car payment is $300. Student loans are $200. Credit card minimums are $100. That is $600 in monthly debts. Divide $600 by 5,000 and you get 12%. Now add the mortgage payment you want. If that is $1,500, your total monthly debts become $2,100. Divide by 5,000. Your DTI is now 42%. The CFPB reports that rising interest rates have pushed debt burdens higher for mortgage borrowers, and DTI has become a more common reason for loan denials. Most lenders want your DTI at or below 43%. Some programs allow up to 50%, but the lower your DTI, the better your chances of approval, and the better your interest rate. The lesson? Pay down your debts before applying for a mortgage. Every dollar of debt you eliminate improves this number. This is one of the most important slides in this entire course, and most people completely skip this step. Shopping for lenders. A Freddie Mac study found that most first-time homebuyers talk to only one lender. Just one. Even though they know comparison shopping will save them money. Why do people do this? Nobel Prize winner Richard Thaler would say it is because of irrational consumer behavior. We are lazy. We trust the first person who talks to us. We assume all lenders are the same, but they are not. The CFPB has stated that failing to comparison shop costs the average homebuyer approximately $300 per year and many thousands over the life of the loan, just from not shopping around. So here's what you do. Talk to at least 3 to 5 lenders. Get quotes from big banks, credit unions, and online lenders. Compare not just the interest rate, but also the closing costs, the fees, the points, and the loan terms. Ask each lender for a loan estimate form, which is a standard document that makes comparison easy. The person who shops around is the person who wins, every single time. Do not be lazy with this step. So you found a house, got approved for a loan. Now what? Closing costs. These are the extra fees you pay on the day you officially buy the house, and they are not small. Closing costs typically run between 2 to 5% of the loan amount. So on a $300,000 home, you could be looking at $6,000 to $15,000 on top of your down payment. What is included in closing costs? A lot of things. Loan origination fees, which is what the lender charges for processing your loan, appraisal fees to make sure the house is actually worth what you are paying, title insurance to protect against ownership disputes, attorney fees, recording fees, and more. The list can be long and confusing, and that is exactly what some lenders count on. According to financial experts at Bankrate, many first-time buyers only budget for the down payment and are shocked when they see the closing cost numbers. Do not make this mistake. Budget for closing costs from the very beginning. And here's a pro tip. Some of these fees are negotiable. You can ask the seller to pay a portion. You can ask the lender to reduce their fees. You can even roll some costs into the loan. Just know that rolling costs in means you are paying interest on those fees for 30 years, so weigh your options carefully. You will hear the word escrow a lot during the home buying process. It has 2 meanings and both are important. First, during the buying process, escrow is a neutral third party that holds your money while the deal is being completed. Think of it like a referee in a football match. The referee does not play for either team. The referee just makes sure everyone follows the rules. The escrow company holds your deposit until all conditions are met and then releases the funds. The second meaning of escrow relates to your monthly payment after you buy the home. Many lenders require an escrow account where they collect money each month for your property taxes and homeowner's insurance. Instead of you paying those bills once or twice a year in big lump sums, the lender divides them into 12 parts and adds a piece to each monthly mortgage payment. This can actually be helpful because it forces you to save for those big bills. but it also means your monthly payment is higher than just principal and interest alone. Your total monthly payment, which lenders call PITI, includes principal, interest, taxes, and insurance. Always look at the full PITI number, not just the principal and interest. The PITI is the real number you need to be able to afford comfortably. And I mean comfortably, not barely scraping by every month. Before the bank gives you the money, they want to make sure the house is worth what you are paying for it. Makes sense, right? The house is their collateral. If you stop paying, they need to be able to sell it and get their money back. So they order an appraisal. A licensed appraiser visits the property, looks at its condition, measures it, and compares it to similar homes that recently sold in the area. If the appraisal comes in at or above the purchase price, great, everything moves forward. But if the appraisal comes in below the purchase price, uh-oh, that means the bank thinks you are paying too much. It is like trying to get a car loan for $50,000 on a car the dealer says is only worth $35,000. The bank is not going to lend you $50,000. They will only lend based on what they think it is worth. When this happens, you have a few options. You can ask the seller to lower the price. You can pay the difference out of your own pocket. You can challenge the appraisal. Or you can walk away from the deal if your contract has an appraisal contingency. This is why contingencies in your purchase contract are so important. They protect you from getting locked into a bad deal. We will cover contingencies in more detail very soon. An appraisal tells you what the house is worth. A home inspection tells you what is wrong with it. These are two completely different things, and you need both. A home inspector goes through the entire house and checks everything: the roof, the foundation, the plumbing, the electrical system, the heating and cooling, everything. According to housing experts at SD Housing, first-time buyers often skip the home inspection to save money. This is one of the worst financial decisions you can make. Imagine buying a house and 3 months later discovering the foundation has cracks that cost $20,000 to repair, or the roof needs full replacement at $15,000. That inspection fee of $300 to $500 could save you from a nightmare. Zillow research found that 75% of recent home buyers had at least one regret. Many of those regrets could have been avoided with a proper inspection. Always, always get a home inspection. And be present during the inspection. Walk through with the inspector, ask questions, take notes. This is your future home. Treat it like the biggest purchase of your life, because it is. A contingency is a condition in your purchase contract that says, this deal only goes through if this specific thing happens. They are your safety nets. Without them, you could be trapped in a deal that goes sideways. The three most common contingencies are the inspection contingency, the appraisal contingency, and the financing contingency. The inspection contingency says, if the inspection finds serious problems, I can renegotiate or walk away. The appraisal contingency says, if the house does not appraise at the agreed price, I can renegotiate or walk away. The financing contingency says, if my loan falls through, I can walk away and get my deposit back. These three clauses protect you from the three biggest risks in any home purchase. Now, in hot markets where there are many buyers competing for few homes, some people waive their contingencies to make their offer more attractive to the seller. This is dangerous. According to Zillow research, only about 1 in 10 buyers actually waive inspections, and for good reason. Waiving contingencies is like skydiving without a parachute just because someone dared you. Keep your safety nets. A good deal is not worth it if it comes with hidden disasters. Your interest rate is not just one random number the bank picks out of a hat. The CFPB outlines 7 key factors that determine the rate you get. We already talked about credit score, but your location also matters. Lenders offer slightly different rates depending on what state you live in. Your down payment size matters. Putting 20% down usually gets you a lower rate than putting 5% down. The loan type matters. Conventional, FHA, VA, and USDA all come with different rate structures. The loan term matters. A 15-year mortgage typically has a lower interest rate than a 30-year mortgage. The type of rate matters. Fixed rates are usually higher than the initial rate on adjustable rate mortgages. And finally, the overall economic environment matters. When the economy is strong and inflation is high, rates tend to go up. When the economy slows down, rates tend to go down. Here is the takeaway. You have control over many of these factors. You can improve your credit, you can save a bigger down payment, you can choose a shorter loan term, you can pick the right loan type. Even saving a fraction of a percent can save you thousands over the life of your loan. The CFPB confirms that even small rate differences add up to massive savings, so do not just accept the first rate you are offered. Negotiate. All right, let us talk about discount points. This is something many buyers hear about, but few truly understand. A discount point is basically prepaid interest. You pay a fee up front at closing, and in return, the lender gives you a lower interest rate for the life of the loan. 1 point equals 1% of the loan amount. So on a $300,000 loan, 1 point costs $3,000. The CFPB reports that the percentage of homebuyers paying discount points roughly doubled from 2021 to 2023 as interest rates rose. Nearly 9 out of 10 borrowers doing cash-out refinances paid points. And borrowers with lower credit scores were even more likely to pay points. So, should you pay points? It depends on how long you plan to stay in the home. If you pay $3,000 for a point that saves you $75 a month, it takes you 40 months, or about 3.5 years, to break even. After that, you are saving money every single month. So if you plan to stay in the house for 10 or 20 years, points can be a great investment. But if you are moving in 5 years or less, probably not worth it. Do the math. Do not just trust the lender's recommendation. Here is a decision that will shape your financial future for decades. Do you get a 15-year mortgage or a 30-year mortgage? The 30-year is by far the most popular. Lower monthly payments, more breathing room. But the 15-year? It is the wealth builder. Let me show you the difference with real numbers. According to mortgage rate history data, a $400,000 loan at a 30-year fixed rate of 6.75% would cost roughly $534,000 in total interest. The same loan with a 15-year fixed rate of 5.75% would cost only about $208,000 in interest. That is a savings of over $326,000. $326,000! Of course, the monthly payment on a 15-year loan is significantly higher. And that is the trade-off. You pay more each month, but you save a fortune in interest and own your home free and clear in half the time. It is like choosing between eating fast food every day for cheap or cooking at home, spending a bit more time and effort, and being healthier for life. The 15-year mortgage is the cooking-at-home option. It takes more discipline, but the results are incredible. This is the trick I promised you earlier, the one that banks hope you never figure out: making extra payments on your mortgage principal. Even small extra payments can save you tens of thousands of dollars and shave years off your loan. And I mean that literally. Here is a real example. Say you have a $250,000 mortgage at 6% for 30 years. Your monthly payment is about $1,500. If you add just $100 extra per month toward the principal, you will pay off the loan about 5 years early and save roughly $45,000 in interest. $100 a month. That is like skipping a few restaurant dinners each month and getting $45,000 back in return. And it gets even better. Some people make one extra mortgage payment per year, which is even easier to budget for. Others round up their payments. Instead of paying $1,500, they pay $1,600. Every dollar that goes directly to the principal reduces the amount of interest you pay going forward, because interest is calculated on the remaining balance. The less you owe, the less interest they charge. It is a snowball effect that works in your favor. Start early. Start small. But start. Life changes. Interest rates change. And sometimes, the mortgage you got 3 years ago is no longer the best deal available. That is where refinancing comes in. Refinancing means replacing your current mortgage with a new one, usually with better terms. Maybe rates have dropped and you want a lower rate. Maybe you want to switch from a 30-year to a 15-year. Maybe you want to switch from an ARM to a fixed rate before your adjustable rate goes up. When you refinance, you are essentially getting a brand new loan. The new loan pays off the old one, and you start fresh with new terms. But here's the thing. Refinancing is not free. You will pay closing costs again, usually 2 to 5% of the loan amount. So you need to make sure the savings from the new rate actually outweigh the cost of refinancing. The general rule of thumb is this. If you can lower your rate by at least 3/4 of a percentage point, and you plan to stay in the home long enough to recoup the closing costs, refinancing makes sense. It is like switching phone plans. Sure, there is a bit of hassle to change providers, but if the new plan saves you $50 a month, after a few months, the switch pays for itself. Do the math. Ask the lender for a break-even analysis. And always, compare offers from multiple lenders when refinancing too. Let us talk about equity. Equity is the portion of the home that you actually own. If your home is worth $400,000 and you owe $250,000 on your mortgage, your equity is $150,000. That is your money. That is wealth you have built. According to data from the Federal Reserve, American homeowners held roughly $35.8 trillion in real estate equity through mid-2025. That is a staggering amount of wealth. Equity grows in two ways. First, every mortgage payment you make reduces your principal, which increases your equity. Second, if your home's value goes up, your equity goes up too. Think of it like a savings account that grows from two directions. You are depositing money by paying your mortgage, and the account itself is growing because the property is appreciating. Now, the data also shows that only about 2.2% of mortgage properties were underwater in the third quarter of 2025, meaning the owner owed more than the home was worth. That number is far below the record high of 26% in 2009 during the financial crisis. Building equity is one of the biggest reasons home ownership creates generational wealth, and we are going to discuss how to build equity faster in the next section. So how do you build equity faster? I already mentioned extra payments, but there are other strategies too. First, make improvements to your home that increase its value. Not all improvements are equal, though. Updating a kitchen or bathroom typically gives you a high return, while adding a swimming pool in a cold climate, not so much. Choose projects that buyers in your area would actually pay more for. Second, consider making bi-weekly payments instead of monthly. Instead of paying once a month, you pay half the amount every 2 weeks. Since there are 52 weeks in a year, you end up making 26 half payments, which equals 13 full payments instead of 12. That one extra payment per year goes straight to principal and can shave years off your mortgage. Third, avoid taking on a home equity line of credit, or HELOC, unless you absolutely need it. A HELOC lets you borrow against your equity, which sounds nice, but it is literally reducing the wealth you have built. It is like filling a bathtub and then poking holes in the bottom. The families who build the most wealth from home ownership are the ones who protect their equity, grow it consistently, and avoid borrowing against it every time they want a new car or vacation. Discipline wins. If you are a first-time home buyer, you have more help available than you probably realize. There are over 800 federal, state, and local programs designed to help first-time buyers get into a home. According to data from homebuyer.com, these programs include down payment assistance grants, low-interest loans, tax credits, and closing cost assistance. The 5 main types of first-time buyer help are grants that do not need to be repaid, forgivable loans that go away after you live in the home for a set number of years, low-interest second mortgages, tax credits that reduce how much you owe in taxes, and subsidized interest rates that give you below-market deals. Many of these programs have income limits, but some are first-come, first-served with no restrictions. According to the National Association of Realtors, first-time homebuyers made up a record low of only 24% of all buyers in 2024, down from 32% the year before. The average age of a first-time buyer jumped to 38. Home ownership is getting harder, but these programs exist to help you. Search your state's Housing Finance Authority website. Ask your lender. Ask your real estate agent. Do not leave free money on the table. It is there for you, but only if you ask for it. Let me paint the full picture of what your monthly housing cost really looks like, because it is more than just the mortgage payment. According to data from the U.S. Census Bureau, homeowners who moved into a new home in 2024 and had a mortgage paid a median of $2,225 per month. That is the highest figure for recent movers in over 15 years. But what is inside that number? Principal and interest, yes, but also property taxes, homeowners insurance, and possibly PMI and HOA fees. Let us break down a real scenario. On a $300,000 home with 20% down and a 6% rate, your principal and interest alone might be about $1,400. Add $200 for property taxes. Add $150 for homeowners insurance. Maybe $50 for HOA. Now you are at $1,800, without PMI. If you put less than 20% down, add another $100 to $200 for PMI. Suddenly that affordable home costs $2,000 a month. The general guideline is to keep your total housing cost at or below 28% of your gross income. So if you earn $6,000 a month before taxes, your total PITI should stay under about $1,680. I know, it is tight. But this rule exists to keep you from becoming house poor, where you own a beautiful home but cannot afford to actually live your life. Budget realistically. Be honest with yourself. Property taxes are the ongoing cost of homeownership that never goes away. Even after you pay off your mortgage completely, you still owe property taxes every year. Property taxes fund your local schools, police, fire departments, roads, and public services. The amount you pay depends on two things: the assessed value of your home and your local tax rate. Here is how it works in real life. Say your home is assessed at $300,000 and your local tax rate is 1.2%. You owe $3,600 per year in property taxes. That is $300 per month. But if you live in a state with high property taxes, like New Jersey or Illinois, that rate could be closer to 2 or even 2.5%. On the same home, that is $6,000 to $7,500 a year. And here is something people forget. Property taxes can increase over time. Your home gets reassessed, your local government raises rates, and suddenly your tax bill is higher than when you bought the house. This is why it is critical to research property taxes in any area you are considering. It is not enough to afford the mortgage. You must be able to afford the taxes too. Some states also offer property tax exemptions for certain buyers like veterans, seniors, or disabled individuals. Check what is available in your area. Homeowners insurance protects you if something bad happens to your property. Fire, storm damage, theft, certain natural disasters. If you have a mortgage, your lender will require you to have homeowners insurance. This is non-negotiable. The lender wants to make sure their collateral is protected. The cost varies based on where you live, the size and age of your home, your coverage limits, and your deductible. On average, a typical policy might run you between $1,000 and $3,000 per year. But if you live in an area prone to hurricanes, wildfires, or flooding, your insurance costs can be much higher. And standard policies usually do not cover flood damage. That requires a separate flood insurance policy. Here is a tip that can save you money. Shop around for insurance the same way you shop around for lenders. Get quotes from at least 3 insurance companies. Ask about discounts for bundling your home and auto insurance. Ask about security system discounts. Increase your deductible to lower your premium, but only if you have enough savings to cover that higher deductible in an emergency. Insurance is one of those costs people set and forget, but reviewing it every year can put hundreds of dollars back in your pocket. If you buy a home in a planned community, a condo, or a townhouse, you will probably deal with a homeowners association, or HOA. An HOA is an organization that manages and maintains shared spaces and enforces community rules. You pay monthly or quarterly fees to the HOA, and those fees can range from $50 a month to several $100s a month, depending on the community. What do HOA fees cover? Usually things like landscaping of common areas, pool maintenance, gym access, security, exterior building maintenance for condos, and trash removal. Some HOAs cover water or even insurance for the building structure. But here's the catch. HOA fees can increase, and they often do. The HOA board votes on budgets, and if costs go up, your fees go up. Also, HOAs have rules. Some are reasonable, like not parking boats in your driveway or keeping your lawn maintained. Others can feel really restrictive, like telling you what color you can paint your front door, or saying you cannot put up a basketball hoop for your kids. Always read the HOA covenants, conditions, and restrictions before buying. I have seen people buy condos and then discover they cannot rent them out, cannot have pets over a certain weight, or face fines for leaving their garage door open. Read the rules before you buy. All right, let us walk through the actual mortgage application process. When you are ready to apply, the lender will ask for a lot of documentation. And I mean a lot. Be ready. They will want your last 2 years of tax returns, your recent pay stubs, usually from the last 30 days, bank statements from the last 2 to 3 months, W-2 forms, identification, and if you are self-employed, buckle up because they want even more. Self-employed borrowers typically need to provide profit and loss statements, business tax returns, and sometimes a letter from their accountant. In 2024, lenders approved and funded about 3.97 million mortgages out of 7.77 million applications submitted. That means roughly half of all applications were denied or withdrawn. Half. The process from application to closing typically takes 30 to 45 days, but it can take longer if there are issues. During this time, do not make any big financial moves. Do not open new credit cards. Do not buy a car. Do not quit your job. Do not make large deposits into your bank account that you cannot explain. All of these things can raise red flags with the lender and derail your approval. Stay calm, stay steady, and let the process work. Within 3 business days of applying for a mortgage, the lender is required by law to give you a loan estimate. This is a standardized form created by the CFPB that shows you all the key details of the loan: interest rate, monthly payment, total closing costs, and the estimated total you will pay over the life of the loan. It is your most powerful comparison tool. The loan estimate has 3 pages. Page 1 shows the loan terms, projected payments, and costs at closing. Page 2 breaks down the closing costs in detail: origination fees, appraisal costs, title fees, government charges, everything. Page 3 shows comparisons, including the total amount paid if you hold the loan for 5 years, and contact information. Here is the key. Get loan estimates from multiple lenders and put them side by side. The form is designed to make comparison easy. Same categories, same layout. You can see exactly who is charging more and for what. This is how you negotiate. This is how you get the best deal. Some people save thousands just by waiving a competitor's loan estimate in front of their preferred lender and saying, "Can you beat this?" Try it. Closing day. This is the day you officially become a homeowner. But before you pop champagne, let us walk through what actually happens. You will sit down at a closing table, usually at a title company or attorney's office, and you will sign a mountain of paperwork, 30 to 50 pages sometimes. Your hand will be tired by the end. I am not joking. The most important documents you will sign are the promissory note, which is your promise to repay the loan, the mortgage deed or deed of trust, which gives the lender a lien on your property, the closing disclosure, which is the final version of all your costs, and the deed, which officially transfers ownership to you. Before signing, compare the closing disclosure to your loan estimate. They should be very similar. If you see fees that jumped up significantly or new charges that were not on the original estimate, ask why. You have the right to question every number. Do not let the excitement of buying your dream home cause you to blindly sign things you do not understand. Take your time. Ask questions. This is the biggest financial commitment of your life. Treat it that way. Let us talk about mistakes, because this course would not be complete without addressing the pitfalls that trap people every single day. According to the Clever Real Estate study, 43% of recent buyers have struggled to make their mortgage payments, and 44% had to take on additional debt just to maintain their lifestyle after buying. That is nearly half of all buyers drowning after the purchase. The biggest mistakes: buying more house than you can afford, not having an emergency fund, skipping the home inspection, not shopping around for lenders, using all your savings on the down payment and having nothing left for repairs. Imagine moving into your dream house and then the water heater breaks in the first month. No emergency fund means that repair goes on a credit card at 20% interest. Now you are paying high interest on a water heater inside a house you are already paying interest on. That is debt stacking, and it is brutal. According to financial expert Dave Ramsey, your monthly mortgage payment should be no more than 25% of your take-home pay. That includes taxes and insurance. If you stick to this rule, you will have room to breathe. Room for emergencies. Room to actually enjoy your home instead of just surviving inside it. Be disciplined. Be smart. Be patient. We touched on this briefly, but let me go deeper into the 28% rule because it is one of the most useful guidelines in all of home buying. The 28% rule says your total monthly housing cost should not exceed 28% of your gross monthly income. Gross means before taxes. So, if your household earns $72,000 a year, that is $6,000 a month gross. 28% of $6,000 is $1,680. That is your maximum for total housing costs, including principal, interest, taxes, insurance, PMI, and HOA. Anything above that, and you are at a higher risk of financial stress. There is also a related rule called the 36% rule. This one says your total debt payments, including housing plus all other debts, should not exceed 36% of your gross income. Using the same $6,000 income, 36% is $2,160. So if your housing costs are $1,680, you only have $480 left for all other debts. Car payments, student loans, credit cards, everything. These rules exist because study after study shows that when people exceed these limits, financial distress follows. Follow the rules. Your future self will thank you. According to real estate experts at Chase, one of the top mistakes first-time buyers make is focusing on the house and ignoring the neighborhood. You can renovate a kitchen, you can add a bedroom, but you cannot change the neighborhood. The location is permanent. Before you buy, research the area thoroughly. Drive through it on a Saturday night and see what the vibe is. Check if the commute to your job takes 20 minutes or an hour. Look up the crime statistics. Find out what schools are rated the highest if you have or plan to have children. Check if there is a grocery store nearby, or if you have to drive 30 minutes just to buy bread. A great house in a bad neighborhood is a bad investment. A modest house in a great neighborhood is a good investment. Property values in strong neighborhoods tend to appreciate faster. Schools, safety, walkability, access to public transit, nearby parks and restaurants, these things matter. They affect your daily quality of life and the future resale value of your home. Buy the neighborhood first, then find the right house inside it. Should you use a real estate agent? Yes, especially as a first-time buyer. A good buyer's agent knows the local market inside and out. They can spot overpriced homes. They know how to negotiate. They handle mountains of paperwork, and they guide you through the emotional roller coaster of buying a home. According to the National Association of Realtors, what buyers want most from an agent is honesty, market knowledge, and responsiveness. Not every agent delivers on that. So do your homework. Interview at least 2 or 3 agents. Check their reviews online. Ask them how many homes they have helped buyers purchase in the last year. An agent who closes 2 deals a year versus one who closes 30 is going to have very different levels of expertise. And here is something many buyers do not know. In most transactions, the seller pays the buyer's agent commission, so your representation is essentially free to you. There are some recent changes to commission rules, so always ask up front about how your agent gets paid. But the bottom line is this: a great agent is an asset. A bad agent is a liability. Choose carefully. Everyone wants to know, is now a good time to buy? And the honest answer is, it depends on your situation more than the market. People have been trying to time the housing market for decades. Some win, most do not. The truth is, real estate tends to appreciate over time. Home prices may dip temporarily, but over 10, 20, 30 years, they almost always go up. According to data from the U.S. Census Bureau, home values kept rising for all homeowners in 2024, regardless of when they moved in. The people who bought during the expensive market of 2020 and 2021 are already sitting on significant equity gains. The people who waited for a crash that never came, they are still renting. The best time to buy is when you are financially ready. Stable income, low debt, good credit, emergency fund in place, down payment saved. If you meet those conditions, the market timing becomes less important because you are playing the long game. You are not flipping the house next year. You are building wealth over decades. And over decades, real estate has been one of the most reliable wealth-building tools in human history. Ready is the best time. Not later, not when rates drop. Ready. Here is something that confuses a lot of new homeowners. You get your mortgage from Lender A. You make your first few payments to Lender A. Then one day you get a letter saying, your loan has been transferred to Lender B. Wait, what? This is called mortgage servicing transfer, and it is completely normal. The company that gave you the loan can sell the servicing rights to another company. This means you will make your payments to a different company, but your loan terms, interest rate, and balance do not change. Only the address where you send your payment changes. It can happen multiple times over the life of your loan. When this happens, you have a grace period during the transfer. You cannot be charged a late fee during the first 60 days after the transfer. If you have automatic payments set up, you will need to update them with the new servicer. Keep all letters about servicing transfers. Note the new company's contact information, and make sure your first payment to the new servicer actually goes through. Do not let a servicing transfer turn into a missed payment that hurts your credit. Stay on top of it. Home ownership comes with some nice tax benefits. The biggest one is the mortgage interest deduction. If you itemize your taxes, you can deduct the interest you pay on your mortgage, up to $750,000 of loan debt. So if you paid $18,000 in mortgage interest this year, that could reduce your taxable income by $18,000. Depending on your tax bracket, that might save you several $1,000s in taxes. You can also deduct your property taxes, up to a combined limit of $10,000 for state and local taxes, known as the SALT cap. If you paid points when you got your mortgage, those may be deductible too. And if you ever sell your home for a profit, you may be able to exclude up to $250,000 in gains from taxes if you are single, or $500,000 if you are married filing jointly. That is a huge benefit. Now, tax laws change. What I just described is based on current rules, but Congress can modify these benefits at any time. Always consult a tax professional about your specific situation. But the point is this: home ownership is one of the few remaining areas where the government actually gives you tax breaks for building wealth. Take advantage of every deduction you qualify for. Every dollar saved in taxes is a dollar earned. I need to talk about something serious: mortgage fraud. It is more common than you think. Research cited by mortgage data analysts found that fraudulent borrowers who lied about occupying a property as their primary home defaulted at a 75% higher rate than honest investors. These fraudulent borrowers accounted for over 11% of default dollar volume, despite making up less than 4% of loan originations. But fraud does not just come from borrowers lying on applications. It can also come from predatory lenders who steer you toward bad loans, inflate fees, or pressure you to sign documents you do not understand. And it can come from wire fraud scammers who send fake closing instructions and steal your down payment money through email hacking. This happens more often than you would believe. Protect yourself. Never wire closing funds based solely on an email. Always call your title company to verify wiring instructions using a phone number you already have, not one from the email. Read every document before you sign. If something feels wrong, stop and ask questions. And never, ever lie on a mortgage application. Not about your income, your debts, your occupancy plans, or anything else. Mortgage fraud is a federal crime. It is not worth the risk. The mortgage industry is changing fast. According to data from Fortunely, the share of mortgages originated by fintech lenders grew from just 2% in 2010 to over 17% by 2025. Online lenders are becoming a serious force in the market, and for good reason. They are often faster, more convenient, and sometimes offer better rates because they have lower overhead costs. With online lenders, you can submit documents, get pre-approved, track your application, and even close your loan, all from your phone or computer. It is like ordering food delivery versus driving to the restaurant. Same food, but way more convenient. And just like with restaurants, you still need to check the reviews before you order. But convenience has a trade-off. Online lenders may not offer the same level of personal guidance as a local bank or credit union where you can sit across from someone and ask questions. For first-time buyers especially, having a human being who can walk you through things step by step can be invaluable. My advice? Get quotes from both online and traditional lenders. Compare them. Use the best of both worlds. Technology is a tool. Use it wisely. Let us go deeper into government-backed loans because for many buyers, these are the best options available. FHA loans, insured by the Federal Housing Administration, require a minimum credit score of just 580 for the 3.5% down payment option. If your score is between 500 and 579, you can still get an FHA loan with 10% down. These loans are specifically designed for people who have less than perfect credit or limited savings. According to CFPB data, about 4 out of every 5 FHA borrowers in 2023 were first-time homebuyers. That tells you how important this program is for people getting started. The downside? FHA loans require mortgage insurance for the entire life of the loan. You pay an upfront premium and an annual premium. The only way to get rid of it is to refinance into a conventional loan once you have enough equity. VA loans are even more generous for those who qualify. No down payment, no monthly mortgage insurance, competitive rates. If you have served in the military, this is one of the best benefits available to you. USDA loans offer zero down payment for homes in eligible rural areas. Each program has specific requirements, but the common thread is this: the government wants people to own homes. These programs are proof of that. Use them if you qualify. Let us revisit adjustable rate mortgages because they deserve a closer look. An ARM is usually described with 2 numbers, like a 5/1 ARM or a 7/1 ARM. The first number is how many years the initial fixed rate lasts. The second number is how often the rate adjusts after that initial period. So a 5/1 ARM has a fixed rate for 5 years, then adjusts every year after that. During that initial fixed period, the rate is usually lower than what you would get on a 30-year fixed mortgage. That lower rate means lower payments. And if you know you are selling the house or refinancing within that 5 or 7-year window, you save money during the time you are there. It is a calculated bet. But here are the risks. If you are still in the house when the adjustment period starts, your rate could jump significantly. ARMs have caps. There is usually an initial adjustment cap, a periodic adjustment cap, and a lifetime cap. For example, a 2/2/5 cap means the rate can go up by a maximum of 2% at the first adjustment, 2% at each adjustment after that, and 5% total over the life of the loan. So if you started at 4%, the most you could ever pay is 9%. That is still a big jump. Know your caps. Read the fine print. ARMs are tools, not toys. What happens when the house you want costs more than the conforming loan limit? You need a jumbo loan. Conforming loan limits are set by the Federal Housing Finance Agency and change each year. For most areas, the limit is around $766,000. In high-cost areas like San Francisco or New York City, it can go up to about $1.15 million. Anything above that requires a jumbo loan. Jumbo loans are not backed by Fannie Mae or Freddie Mac, which means lenders take on more risk. Because of that higher risk, jumbo loans traditionally came with higher interest rates. But according to mortgage rate tracking data, an interesting flip happened in 2025, where jumbo rates actually fell below conforming rates, creating great deals for jumbo borrowers. However, jumbo loans typically require higher credit scores, usually 700 or above, larger down payments, often 20% or more, and lower debt-to-income ratios. They are harder to qualify for, but if you are buying in an expensive market, they are your only option. Shop around aggressively for jumbo rates because the spread between lenders can be even wider than with conventional loans. Before you can close on a home, a title search must be done. This is a deep dive into the property's ownership history to make sure the seller actually has the right to sell it and that there are no hidden claims or liens against the property. Imagine buying a house and then finding out 6 months later that the previous owner's ex-spouse still has a legal claim on the property, or that there is an unpaid contractor's lien from 5 years ago. A title search catches these problems before you buy. A title company or attorney conducts this search by going through public records, court filings, and historical documents. They look for things like outstanding mortgages, tax liens, judgment liens, easements, and ownership disputes. If the title is clear, you are good to go. If there are issues, they need to be resolved before closing. This is also why you purchase title insurance. There are 2 types: lender's title insurance, which your lender requires, and owner's title insurance, which protects you. Owner's title insurance is optional, but strongly recommended. It is a one-time cost that protects you for as long as you own the home. If a long-lost heir shows up 20 years from now claiming they own the property, your owner's title insurance has your back. Get it. Do not skip it. In competitive markets where homes get multiple offers within days or even hours, how do you stand out? First, have your pre-approval letter ready and in hand. Second, make a strong offer. In a hot market, offering below asking price is usually a waste of time. Your agent can help you determine a competitive offer based on comparable sales. Third, write a personal letter to the seller. This does not always work, and some sellers cannot legally consider it, but when it is allowed, a heartfelt letter about why you love the home and what it would mean to your family can make a difference. Fourth, minimize contingencies where you can do so safely. Maybe you get a pre-inspection done before making the offer, so you do not need the inspection contingency. But remember, we talked about this. Be careful about waiving contingencies. Fifth, be flexible with the closing date. Sometimes the seller needs more time to move out. If you can accommodate their timeline, that makes your offer more attractive. And sixth, consider an escalation clause, which automatically increases your offer up to a certain amount if another buyer outbids you. Buying in a hot market is stressful, but with preparation and strategy, you can compete and win. Not all listings are what they seem. Learning to spot red flags can save you from making a terrible purchase. Watch out for phrases like "as is," which usually means the seller knows there are problems and does not want to fix them. Handyman special or investor opportunity often means the house needs major work. Cozy usually means tiny. Unique layout usually means weird. Beyond the language, look at the photos. If the listing has very few photos or only shows certain rooms, ask yourself what they are hiding. If the photos are taken at unusual angles or with a wide-angle lens that makes rooms look bigger than they are, be cautious. If every photo is taken from one corner of each room, that is like someone only showing you their good side in every picture. What does the other side look like? Also look at how long the house has been on the market. If it has been sitting for months while similar homes sell in days, something is probably wrong. Price too high? Bad location? Known issues? Ask your agent to dig into the property's history. Check if it has been relisted multiple times. Check for price reductions. All of these clues tell a story, and you want to read that story before you write an offer, not after. Behind the scenes of your mortgage approval, there is a person you will probably never meet who holds enormous power over your home buying journey: the underwriter. The underwriter is the person at the lender's office who reviews all of your financial documents and makes the final decision on whether to approve your loan. They check everything: your income, your assets, your debts, your credit history, the property appraisal, the title search. They look for inconsistencies, risks, and anything that does not add up. Think of the underwriter as a detective who gets paid to find reasons to say no. Your job is to give them 0 reasons to say no. During underwriting, you may get requests for additional documents. This is called a conditions list. Maybe they need a letter explaining a large deposit in your bank account. Maybe they need an updated pay stub. Maybe they need a letter from your employer confirming your job is stable. Respond to these requests quickly and completely. Delays from you delay your closing. And remember, do not make any big financial changes during underwriting. No new debt, no big purchases, no job changes. Stay boring until you have the keys in your hand. Listen to me carefully. Do not buy a home without an emergency fund. I do not care how excited you are. I do not care if it is your dream house. If you drain every dollar you have for the down payment and closing costs, you are setting yourself up for a crisis the moment something goes wrong. And something will go wrong. The washing machine will break in month 3. A pipe will burst in January. The air conditioning will die in the middle of August when it is 100 degrees outside. These are not if situations. They are when situations. Home ownership comes with constant maintenance costs. Experts suggest budgeting 1 to 4% of your home's value per year for maintenance. On a $300,000 home, that is $3,000 to $12,000 annually. Have at least 3 to 6 months of your total living expenses saved before you buy. This emergency fund sits in a separate account and is only touched for true emergencies. Not vacations, not new furniture. Emergencies. According to Dave Ramsey's guidelines, you should be completely debt-free with a full emergency fund before buying a home. That may seem extreme to some, but the families who follow this advice are the ones who sleep well at night. Should I rent or buy? This is one of the most debated questions in personal finance, and the answer is not always buy. Buying makes sense when you plan to stay in one place for at least 5 to 7 years, when your monthly ownership costs are similar to or less than rent, and when you have the financial stability to handle unexpected expenses. Renting makes sense when you are not ready financially, when your job might relocate you, when the housing market in your area is extremely overpriced relative to rent, or when you simply need more time to save a proper down payment and emergency fund. Renting is not throwing money away, like some people say. Renting is paying for a place to live without the responsibility of repairs, property taxes, insurance, and potential losses if the market drops. The key metric is the price-to-rent ratio. Take the home price and divide it by the annual rent of a similar home. If that ratio is above 20, renting might actually be the better financial move in the short term. If it is below 15, buying is probably the smarter choice. Between 15 and 20 is a gray area. Run the numbers for your specific situation. Do not let anyone pressure you into buying before you are truly ready. Patience is not weakness. Patience is strategy. Interest rates do not exist in a vacuum. They are heavily influenced by the Federal Reserve, also known as the Fed. The Fed does not directly set mortgage rates, but it controls the federal funds rate, which is the rate banks charge each other for short-term loans. When the Fed raises this rate, borrowing becomes more expensive across the entire economy, including mortgages. When the Fed lowers it, borrowing gets cheaper. According to Freddie Mac's historical data, the 30-year fixed-rate mortgage has averaged just under 8% since 1971. That includes the crazy years of 1981, when rates hit 16.63%. Imagine paying 16% on a mortgage. At that rate, a $200,000 mortgage would cost $2,800 a month just for principal and interest. Compare that to a 3% rate during the pandemic, where the same mortgage cost only $843 a month. This is why it is important to understand the economic climate when you are buying. You do not need to be an economist, but knowing that rates are trending up or down helps you make better decisions about when to lock in your rate and whether a fixed or adjustable rate makes more sense. Watch the Fed's announcements. Follow the trends. Knowledge is power in the mortgage game. When your lender offers you an interest rate, that rate is only valid for a limited time unless you lock it. A rate lock is an agreement between you and the lender that guarantees a specific interest rate for a set period, usually 30, 45, or 60 days. This protects you if rates go up during your closing process. Think of it like this. You see a pair of shoes you love for $100. The store says, "We will hold this price for you for 30 days. During those 30 days, the price might go up to $120 for everyone else, but your price stays at $100 because you locked it in. That is what a rate lock does for your mortgage. There is a risk, though. If rates go down after you lock, you are stuck at the higher locked rate unless your lender offers a float-down option, which allows you to take advantage of lower rates if they drop significantly. Float-down options often come with a fee. The decision of when to lock depends on market conditions and your risk tolerance. If rates are volatile and you found a rate you are happy with, lock it. Do not gamble. A good rate today is better than a maybe better rate tomorrow. Not every lender has your best interests at heart. Predatory lenders target vulnerable borrowers, especially first-time buyers, people with low credit scores, and those who may not fully understand the process. They use deceptive tactics to lock you into loans with unfair terms, excessive fees, and rates that are far higher than you should be paying. Warning signs of predatory lending include a lender who pressures you to act fast and discourages you from shopping around, a lender who encourages you to borrow more than you can afford, a lender who adds unnecessary fees or hides costs in the fine print, a lender who steers you toward an adjustable rate loan when a fixed rate would be more appropriate, and a lender who suggests you lie on your application to qualify for a bigger loan. Protect yourself by always reading every document carefully. Compare offers from multiple lenders. Work with a HUD-approved housing counselor who can review your loan terms for free. And trust your gut. If something feels wrong, if the deal seems too good to be true, or if the lender makes you uncomfortable, walk away. There are plenty of honest lenders out there. You do not need to settle for a predator. Let us step back and look at the big picture. Why does homeownership matter so much for building wealth? because real estate is one of the only assets that regular people can buy with borrowed money and then benefit from the entire value appreciating. You put down $30,000 on a $300,000 house. If that house goes up in value by 10%, it is now worth $330,000. Your $30,000 investment just made you $30,000 in equity. That is a 100% return on your money. Data shows that American households held over $35 trillion in real estate equity as of 2025. That is wealth sitting in homes. For many families, their home is their single largest asset. It is the foundation of generational wealth that can be passed down to children and grandchildren. According to the OECD data cited by mortgage research analysts, the United States ranked only 26th out of 28 countries in outright home ownership. That means many Americans are still building toward full ownership. But that process of building, paying down the mortgage, gaining equity, that is how middle-class wealth has been created for generations. It is not just about having a roof over your head. It is about creating a financial foundation for your future. Not everyone buys a home alone. Co-buying is becoming more common, especially among younger buyers who cannot afford a home on their own. You can buy with a spouse, a partner, a family member, or even a friend. But co-buying comes with complications that you must address up front. First, how will ownership be structured? Joint tenancy means equal ownership, and if one person dies, the other automatically gets the property. Tenants in common means each person owns a specific share and can sell or will their share independently. Second, what happens if one person wants to sell and the other does not? Third, what if one person stops contributing to the mortgage? These are not hypothetical problems. They happen all the time. Before co-buying, get a legally binding co-ownership agreement drafted by an attorney. This document spells out everyone's responsibilities, what happens if someone wants out, how expenses are split, and how disputes are resolved. It is like a prenuptial agreement for your house. Nobody likes talking about worst-case scenarios when they are excited about buying, but the people who plan for problems are the people who survive them. Protect yourself and your relationships. Get it in writing. Congratulations, you own a home. Now you have to maintain it, and maintenance is not optional. Ignoring small problems leads to big, expensive problems. A small roof leak becomes water damage, becomes mold, becomes a $20,000 repair. A clogged gutter becomes foundation erosion, becomes structural issues. Maintenance is how you protect your investment. Create a home maintenance schedule. In the fall, clean your gutters, check your heating system, and seal any cracks around windows and doors before winter. In the spring, inspect the roof, check for water damage, service your air conditioning, and check your smoke detectors. Every month, check your water heater, change air filters, and look for leaks under sinks. It sounds like a lot, but most of these tasks take minutes, not hours. Budget for maintenance costs annually. As I mentioned, 1 to 4% of your home's value per year is the recommendation, so set aside money each month into a home maintenance fund. When something breaks, and it will, you will have the money ready. No panic, no credit card debt, just a smooth fix and back to enjoying your home. The best homeowners are the ones who treat maintenance as a habit, not an emergency response. Let us go deeper into refinancing strategy because when done right, it can save you a fortune. There are two main types of refinancing: rate and term refinancing, where you change your interest rate or loan term, or both, and cash-out refinancing, where you take a new, larger loan and pocket the difference in cash. Rate and term refinancing makes sense when rates have dropped significantly since you got your original loan, or when you want to switch from a 30-year to a 15-year mortgage to build equity faster. The rule of thumb is to refinance if you can lower your rate by at least 0.5 to 0.75 of a percentage point, and you plan to stay long enough to recoup the closing costs. Cash-out refinancing can be useful for major home improvements that increase your property value, or for consolidating high-interest debt. But be very careful here. You are essentially turning your home equity into cash and restarting your loan. If you cash out to pay off credit cards and then run up those credit cards again, you are in a worse position than before. Cash out refinancing is a power tool. In skilled hands, it builds things. In careless hands, it causes damage. Use it wisely or not at all. At some point, you may decide to sell your home. Maybe you are relocating. Maybe you have outgrown the space. Maybe the market is hot and you want to cash in on your equity. Whatever the reason, knowing when and how to sell is just as important as knowing how to buy. The general rule is to stay in your home for at least 5 to 7 years before selling. Why? Because in the early years of your mortgage, most of your payment goes to interest, not principal. You have not built much equity yet. Plus, selling costs between 6 to 10% of the sale price when you factor in agent commissions, closing costs, repairs, and staging. If you sell too soon, you could actually lose money after all those costs. Think of it like planting a tree. If you dig it up after 1 year, you just have a stick with tiny roots. If you leave it for 7 years, you have a strong tree that bears fruit. Your home equity is the fruit. Let it grow before you harvest. And when you do sell, remember that tax benefit we discussed. Up to $250,000 in profit is tax-free for single filers or $500,000 for married couples, as long as you lived in the home for at least 2 of the last 5 years. That is an incredible advantage. All right, we have covered a lot, so let me give you a clear, step-by-step action plan you can follow starting today. Step 1. Check your credit reports and fix any errors. Step 2. Pay down existing debts to lower your DTI. Step 3. Save for a down payment and an emergency fund. Step 4. Research first-time buyer programs in your state. Step 5. Get pre-approved by at least 3 lenders. Step 6. Find a qualified, experienced real estate agent. Step 7. Research neighborhoods before looking at houses. Step 8. Tour homes within your budget, not above it. Step 9. Make an offer with proper contingencies. Step 10. Complete the inspection, appraisal, and closing process carefully, reading every document. Step 11. Set up your mortgage payments and escrow. Step 12. Create a home maintenance schedule and fund. Step 13. Review your mortgage annually to see if refinancing makes sense. Step 14. Make extra payments toward principal whenever possible. And Step 15. Enjoy your home. You earned it. You studied. You prepared. You made smart decisions. That is something to be proud of. We started this video with a staggering number: $13 trillion in mortgage debt, 82% of buyers with regrets, and a system that profits from your confusion. But you are no longer confused. You now understand how home loans work from the inside out: principal, interest, amortization, credit scores, loan types, closing costs, escrow, equity, all of it. According to every study and every expert we covered today, the difference between a successful homeowner and a struggling one comes down to knowledge and preparation. Not luck, not timing, not finding a secret deal. It is about understanding the system, playing by the rules, and making the rules work for you instead of against you. You now have that knowledge. So go out there, take action, follow the plan. And when you finally hold those keys in your hand and walk into a home that is yours, remember this moment. Remember that you chose to learn. You chose to prepare. You chose to be smart about the biggest financial decision of your life. And that is how you win. Not just in real estate, but in life. Now go make it happen!